Oh boy, y'all better buckle up because inflation expectations have just shifted for the CPI data release, which is in less than 2 days from now, which is kind of remarkable. January 12th is when we're going to be seeing the next inflation release. I'll, of course, be live streaming it, but I need to tell you a warning up front. Inflation expectations have shifted. So what we saw earlier about 2 weeks ago was that inflation expectations went from a headline of 6.7 to 6.5. Month over month was expected to come in at 0.0 and core coming in at 0.3. So the headline going from 6.7 to 6.5 and that sort of reduction down in inflation being clear. But this just changed again. This morning, this number right here, headline month over month, for the first time in this crazy cycle, is now expected to come in at not just 0.0, not 0.1, but negative 0.1. That's the expectation now. Now, I actually get nervous when we have low expectations like that. As excited as I am that we're seeing those expectations move down rather than up, and we're going to talk about how the market might react to those in just a moment. One of the things that I hate is when the surveys are so low, it makes it harder to beat the surveys to the downside, right? I mean, think about it. If the surveys were 0.1 and we got negative 0.1, everybody'd be having a party. If the survey is -1 and we actually get 0, everyone's disappointed, even though that's better than coming in at 0.1 positive, right? So the whole expectations thing with the market is just nutso. And in the short term, beating these or missing these really matters a lot. In fact, let's look at how the market might react based on JP Morgan's opinion. That's this. Actually, let's start with this chart right here. So if we get a headline read of above 6.6, now remember, the current consensus is 6.5. So now they're suggesting if we get a print above 6.6, one of the better plays would be shorting the JPM cyclicals versus defensive index, and they maybe see the S&P 500 down about 2.5%. They see a 6.6% read from the 7.1% where we are now as a bearish outcome. Even though that trend is nice, it's one of those trends where the Federal Reserve can come out and say, oh, see, we still have more to do. In fact, Bowman, they're doing the summary of her right now here on CNBC. I could just give you the summary. Basically, Bowman's like, the usual talk. She's one of the newer members over at the Fed now, and she's doing her usual, well, basically doing the usual mouthpiece that we see Federal Reserve officials tell us, and that is we're going to continue hiking. So, in other words, probably 0.25 rather than 0 for the next cycle. That's important. I'll explain that in a moment. We are going to keep rates higher for longer, so don't think we're going to cut rates too darn fast. And we still have a lot of work to do. Those were some of the key things that she had to say. You know, Jamie Dimon came out this morning suggesting, hey, there's like a 50% chance the Fed ends up having to run up to 6% on the Fed funds rate. The market doesn't believe this, though, as far as the market can throw it, which given that the market can't throw, except maybe make us throw up, is not very far. So you take a look at this. This is the Fed futures measure of expectations for how much the Fed is likely to hike at the end of January, first day of February. And you can see we're sitting at a 21% probability of actually staying at 0 hike and a 79% probability of us getting a 25 basis point hike. So clearly, the Federal Reserve is noticing this, and they're sending their minions out to the market, to CNBC or whatever, to say, we've got more hikes to do, because the Fed ideally wants this higher and this lower. They don't want the market starting to price in 0 because it eases financial conditions too much. Although I will say, if you go over to bonds right here, they jumped today, 11 basis points on the 10-year, kind of wild. Anyway, let's go back over here and let's look at these different scenarios play out. So they also mention here, if prints come in above 6.8, then think you're catching a tail event. That would, in other words, a tail event is something that is much less likely to happen, right? So generally, when you think about statistics, you want to think about this bell curve. that looks somewhat like this. Right side tail event, and then a left side tail event. Crazy shot to the downside is a left side tail risk. A crazy shot to the upside is a right side tail risk. And so generally we would expect that the result will be somewhere within 1 to 2 standard deviations of this. So sort of 1 standard deviation or 2 standard deviations out. Once you start getting further out, then you start getting into those like crazy rare like 3 sigma events, right? Like 2 deviations out is a 2 sigma event. Who remembers that from Vlad in the Robinhood days? Anyway, let's keep looking at some of the expectations here. Okay. Oh, and I do want to remind you, as a short notice thing, we opened up a few flights that we're doing this week for shadowing me. We're going to be traveling the next 3 days. I'll still be covering CPI Live, but if you want to join those sort of last minute, Wednesday, Thursday, Friday, we've got some space available. You're welcome to join. Otherwise, we're booked out into, I think, mid-February, and then we're filling up February, March, and starting to fill up April. So if you want to come shadow me on the plane as we go look at real estate, link down below. Okay, so let's keep going over here. So then if we get prints between 6.4 and 6.6, remember again, consensus being 6.5 right over here, this is a bullish outcome. So this would be in line, a drop from 7.1, bullish outcome, and think this outcome produces a decline in volatility across assets. Well, that would be nice, although the VIX index is pretty low. But you're just seeing these crazy moves in stocks. I mean, just look at, for example, Tesla. You know, yesterday Tesla was up like 8 or 9%, closes the day up 5.9%. Now it's down 3%. The volatility is crazy. Anyway, given the moves ahead of CPI print, the initial spike is likely to fade through the season. Look for tech to lead in this scenario. Okay, cool. That, they think, is a 65 percentage point possibility that we're going to see something pretty much in line. Now, they do think there's also this chance of shooting to the downside, 6.4%. And this would, they think you would have to really like materially miss to the downside. They see this as relatively a low chance, 20% chance of being anything below 6.4, really a left side tail risk to see something come in even below 6%. Not likely. So more, they actually say here, stated differently, the largest change comes if the market reprices the Fed's March meeting as a pause, which seems likely only if the CPI prints below 4.5 to 5%. Yeah, we're not seeing something coming that low. The outcome produces a 3 to 3.5% rally in the S&P 500. Anything under 6.2 would be their version of a tail event, like a big shock to the downside miss, which would be great. But let's look at those expectations, that 20% probability. So they actually see the odds of a bullish green market tomorrow, if you add these odds together here, at 85%. Now let's hop over here and look at the March meeting, which before the February meeting, we're going to have one CPI report. We'll also have another employment cost index report on the 30th, I believe it is, or the 31st of the month. We'll also have a bunch of earnings for companies that are going to go through. So we'll see those before the Feb 1 meeting. But before the March 15th meeting, we'll also get February's inflation data. And the March 15th data, ooh, this is quite interesting. So look at this. This has the market pricing a 65% chance that we are actually going to be at 2 25 basis point hikes. So 65% chance, 25-25, no March pause. And if we don't get that March pause, they actually have a 46% chance that we're sitting at 4.75 to 5%. And that maybe that pause is actually sitting at May. So really to get that pause moved up over here, where right now we're only pricing in a 16% chance for March, following 25 over here. But then again, there's still this 21% chance the market sees that we get a big miss on CPI tomorrow, not tomorrow, on Thursday, and it's on the 12th, and then the Fed ends up, Fed ends up pausing early. I don't know about that, but that would be quite fascinating. Let's see what else we have in this JPM report. There are some interesting things in here. So here we've got the 3-month average change in employment. They really show you how we've slowed the labor force downshifting from in the first half of the year gaining about 440,000 jobs to now being closer to 366 in Q3 and 247 in Q4. Obviously, we also think that these numbers are vastly overstated as people start taking on multi-jobs. They did indicate that they actually liked seeing a decline in the average work week to 34.3%. They see this as an indicator that there's little pent-up demand for more workers, which is potentially good for keeping that inflation spiral down, or the odds of an inflationary spiral down. They do reiterate, though, that the Fed wants to be very clear here against the narrative of pausing or U-turning too soon. Even though the market thinks this is going to happen, the Fed, in terms of being a mouthpiece of their plans, does not want to send that signal too soon. This is why I personally believe they're probably going to have that very hard face of hiking on until they actually decide to U-turn. And that could end up being too late. But I think the early lead-in signals for that potential U-turn won't be coming too early. The Fed's going to remain pretty anxious and tight for longer. So probably at least 6 more months, which kind of sucks, but is what it is. Then what do we have over here? We've got global outlook scenarios. Soft landing being priced here at about a 25% chance. Hikes after Q1, this would be bad with a hard landing then coming in 2024. So if they keep hiking after Q1, which would be into May, that's probably your hard landing scenario. And then that would maybe be around a 30% probability. Then you do potentially have this trading sideways going on with a recession in late 2023, about a 35% chance here, sitting in a late 2023 recession, or just straight up recession in the first half, 15% chance. So it does seem like statistically, based on these numbers put together by JPM, we're probably looking at some kind of recession between Q3 to Q2. So this would be Q3 2023 and 2024. And somewhere in there, you would probably have already conducted enough damage to keep us in a recession, but you would expect some kind of U-turn from the Federal Reserve within that range. So that could potentially mean that March is the last 25 BP hike, and then you sit still May, you sit still June, right? These are all zeros. And then once you realize, crap, we're probably in a recessionary environment, maybe not even come July, right? We keep seeing the zeros. Maybe come September, you actually start seeing cuts. No guarantees, right? I mean, it's also entirely possible that they just continue going up and we actually approach 6% rather than coming down. But it's all predicated on what CPI does. And so far, the expectations are rosy. Again, though, rosy expectations has a tendency of disappointing. So the fact that those expectations got revised to negative 0.1, I mean, I know that's exciting, and a lot of folks were excited when they saw that revision, but it actually personally makes me nervous because, again, I would have rather had the expectation be 0 and then get 0.1 to the downside, to the negative, right? So who knows? Anyway, thank you so much for watching. Check out the links down below for the programs on building your wealth, for shadowing me, and, well, cheers, folks. We'll see you in the next one. Goodbye.